Ladies and gentlemen, should be my last video for the day. It's an interesting one though. 2-in-1, if you will. Strongest gold buy signal from in 16 years, according to Dave Kranzler. It's again that same guy I've been talking about here recently. InvestmentResearchDynamics.com. Guy has been paying attention to the markets for a very long time, a lot longer than I have. I see his articles from time to time. Recently, I've been seeing them quite a bit, but I read them, of course, and the guy knows what he's talking about. It's that simple. And then there's another article I want to talk about. These are from Silver Doctors. This other one, something wicked this way comes, he says, from Jim Quinn of theburningplatform.com. But first, I want to talk about the gold piece. When gold is accepted as the medium of exchange by most or all nations, an unhampered free international gold standard serves to foster a worldwide division of labor and the broadest international trade, even though the units of exchange, the dollar, the pound, the franc, etc., differ from country to country. When all are defined in terms of gold, the economies of the different countries act as one so long as there are no restraints on trade or on the movement of capital. And that was a quote from Mr., believe it or not, Alan Greenspan, former Federal Reserve Chairman, Gold and Economic Freedom from 1966. And I think that might be why, one of the reasons, Bixweir keeps referring to him as one of the quote-unquote good guys. Anyone who was involved in the financial markets during Greenspan's tenure as chairman of the Federal Reserve would be shocked to see that comment above coming from him. He was, after all, the king of the printing press until his successor, Ben Bernanke, took over the role of chief money and credit creator. While it might not show up in the Fed's M accounts, which are various measures of the money supply, like M2, M3, etc., Greenspan's Fed shepherded an era of unprecedented growth in systemic debt, private and government, and unprecedented decline in credit standards. By the end of Greenspan's reign of monetary terror, anyone with no more than 2 nickels to rub together could qualify for a credit card or a mortgage. And let's see if I can pull this up. This little graph he wants us to take a peek at from 1940 or 45, it looks like, through 2015. Total U.S. debt, all sectors. In the red, we have Greenspan running the Fed. So you can see during his tenure, boy oh boy was some debt created. And then we have this little peak off here, 2008 problem, boom, and then it's back up again. So the graph shows total debt outstanding system-wide in the U.S. during Greenspan's Fed. The level debt increased 400%. GDP, not so much. Real GDP is said to have grown about 85%. But this metric is overstated by the amount that the government underestimates the true inflation rate and the gimmicked changes to the GDP calculation for purposes of political expediency. Debt issues behave like printed money until that debt is paid back. That's the dirty little secret that bona fide economists don't discuss, at least not in public. See the problem of the graph? The level of debt never declines. The small blip down in 2010 was a result of hundreds of billions in bank write-offs for defrauded mortgages, credit cards, and auto loans. In order to measure the true money supply, it's necessary to add together the Fed's M accounts plus the incremental increase in the level of debt each year. But all of this is unnecessary in a system backed by gold. Under a gold standard, the amount of credit that an economy can support is determined by the economy's tangible assets, since every credit instrument is ultimately a claim on some tangible asset. In other words, the massive credit-induced bubbles that occurred during the Greenspan and Bernanke era, each progressively worse, with worse consequences when they burst, could never have occurred if a gold standard was in place in the first place. And therein lies the reason gold is reviled by Wall Street and subjected to government and central bank price controls. Quote, in the absence, and again, this is him, in the absence of gold, the gold standard, there is no way to protect the savings from confiscation through inflation. This is the shabby secret of the welfare status tirades against gold. Deficit spending is simply a scheme for the confiscation of wealth. Gold stands in the way of this insidious process. It stands as a protector of property rights. If one grasps this, one has no difficulty in understanding the statist antagonism toward the gold standard. And again, that was from Greenspan. So he's saying, Dave Kranzler, this is partially at least, and I'd say mostly, why gold is signaling one of its strongest buy signals in at least 16 years. That's his opinion. And again, what happens with silver when gold goes up? It goes up. They go up in tandem. It does not matter. One goes up, they both go up. One goes down, they both go down. So this other one, something wicked this way comes. Once the magical 20,000 Dow is achieved and Trump takes office in January, all bets are off. The establishment is pretending to play nice with Trump, but there is nothing like a 20% crash over a 2-week period to show him who's really the boss. I'm not predicting anything, but it sure looks like something wicked this way comes. By Jim Quinn, theburningplatform.com, which I clicked on the site to check it out. And it's actually the BP oil platform in the Gulf of Mexico on fire. Interesting. I stopped trying to predict markets back in 2008 when the Federal Reserve, Treasury Department, Wall Street bankers, and their propaganda peddling media mouthpieces colluded to rig the markets to benefit the elite establishment players while screwing average Americans. I haven't owned any stocks to speak of since 2006. I missed the final blow-off, the 50% crash, and the subsequent engineered new bubble. But that doesn't stop me from assessing our true economic situation, market valuations, and historical comparisons in order to prove the irrationality of idiocy of the current narrative. The proof of this market being rigged and not based upon valuations, corporate earnings discounted cash flows, or anything related to free market capitalism was the reaction to Trump's upset victory. The narrative was status quo, Hillary was good for markets, and Trump's anti-establishment rhetoric would unnerve the markets. When the Dow futures plummeted by 800 points on election night, left-wingers like Krugman cackled and predicted imminent collapse. The collapse lasted about 30 minutes, as the Dow recovered all 800 points and has subsequently advanced another 1,500 points since Election Day. Krugman's predictive abilities proven stellar once again. It's almost as if the deep state oligarchs and their Wall Street co-conspirators are declaring to the world they are still running the show. Despite deteriorating economic conditions, skyrocketing debt, stagnant wages, and bubbles in the stock, bond, and real estate markets, the narrative being spun is a glorious future of tax cuts, less regulations, jobs coming back to America, and GDP growth so high it will easily pay for all the tax cuts and spending increases. You would think those high-frequency trading machines programmed by Ivy League MBA geniuses would be smart enough to determine when markets are extremely overvalued as fundamentals are deteriorating. Something is not making sense. During the debates, Trump declared on more than one occasion the stock market was in a bubble. It is now 2,000 points higher, and he is proclaiming its advancement as an endorsement of his plan to drastically cut taxes, spend trillions, and make America great again. The financial media, which despised Trump 6 weeks ago, is now peddling an economic recovery, soaring future corporate profits, and a stock market poised to blast through 20,000 to higher and higher all-time highs. I think that would be swell, but let's examine a few facts before putting our life savings in Twitter and Facebook stock. As proof of that Wall Street despises Main Street, When oil prices rise, this is seen as a huge positive by the criminal bankers, as they see oil as an investment to be manipulated for profits. Falling oil and gas prices benefit everyday Americans trying to balance their monthly budgets. The drop in gas prices from $3.70 per gallon in mid-2014 to $1.70 per gallon in early 2016 helped average Americans save enough to partially offset soaring Obamacare costs, rising rents, and stagnant wages. But Wall Street and their corporate media talking heads have cheered the 33% increase in gasoline and the 85% increase in oil since February. Just as with TARP, what is good for Wall Street is not good for Main Street. The Fed narrative of no inflation, supported by sliced, diced, manipulated, massaged, hedonically, and seasonally adjusted drivel produced by the government drones at the Bureau of Labor Statistics, has benefited from the almost 2-year decline in gas and oil prices. That is now reversing itself, as gasoline prices have risen at an annualized rate of over 20% the last 3 months. It is poised to rise by 30 to 40% year over year in the next few months. Even the deep state government bureaucrats are having trouble disguising raging inflation in expenses affecting average Americans on a daily basis. Yellen and her fellow Ivy League academic puppets continue to flog the 2% inflation mantra, as if these theorists have any clue what the ideal rate of inflation should be. Even the manipulated core CPI has been running above 2% for all of 2016. Have you heard any captured media pundit report that CPI has been running at an annualized rate of 3.6% over the last 3 months? The Fed-engineered housing bubble 2.0 has even driven the man-made owner's equivalent rent calculation up to 3.5% annual rate. The Fed's latest bubble-blowing adventure has also driven the home ownership rate to a 50-year low. So much for Bush's ownership society dream. Rental society seems more likely, especially for student debt-burdened millennials working their Obama jobs at Shake Shack. The Fed-induced housing bubble designed to shore up insolvent Wall Street insolvent Wall Street bank balance sheets has priced out millions of Americans and driven rents sky high, especially in metropolitan areas like New York City, San Francisco, D.C., and Chicago. The BLS manipulated data shows an annual increase of 3.9%, while in desirable areas, rents are rising by double digits. The truly hysterical drivel spewed by the BLS drones is that medical care costs are only rising at 4% annual rate and only account for 8.4% of a family's annual costs. The gyration and hedonistic seasonal adjustments they must make to somehow configure 20 to 50% increases in premiums, doubling of copays, and $6,000 deductibles into a 4-year % annual increase must be a wonder to behold as they plug their fake variables into their Excel spreadsheets. Anyone living in the real world, outside of the imperial capital, knows their annual living expenses are rising by at least 5 to 10%. As Obama takes his victory tour, taking credit for the stupendous jobs recovery, the deplorables in middle America know their real wages have barely budged during the entire Obama recovery. If the unemployment rate was really 4.6%, would real wages be growing at less than 1%? No. They'd be growing at 3%, and the Fed funds rate would be at 3%, not 0.50% or 0.5%. With the labor participation rate at a 30-year low of 62.7%, a record number of baby boomers have to work to survive, and 124 million full-time employees supporting 102 million non-working Americans, you might have the real reason Trump won the election. This still goes in line with the previous article. Why gold seems real bullish. Again, gold will balance the balance sheets, the budgets that will be in the future once all these countries deal with this debt problem. And we may still have a few years of enormous debt printing that'll make Obama look like a child with his doubling of the debt. we could see enormous amounts of debt being generated, the debt ceiling going to levels that you thought unimaginable. Unimaginable. I said if we just did the last thing that they did, last with Obama, he had 2 terms as president, the debt doubled from 10 to 20 trillion. If that happens again, and Trump is already saying, I want to come in and spend a lot of money, okay? If it just did what it did last time, nothing more, in other words, the budget and everything, it stayed where it is, that would imply 20 trillion turning to 40 trillion. So even if the rates, somehow they decide, let's pull the rates back down, what is the interest payment we're making on the holders of our debt now at $20 trillion? And if this plays out like I'm talking 8 years from now, 40 trillion. Paying interest on 40 trillion at 1% interest rate is a huge payment when compared to paying that same 1% interest rate at 20 trillion. And I'm not saying we're paying 1%, but I'm just using that same number. This debt has to be dealt with. Unfunded liabilities have to be dealt with. This whole entire system is unsustainable. That is the prime reason I tell people I'm getting precious metals, and I think you should too for these reasons. This was going to save your bacon one day. That day I can't tell you. I can't tell you what one day means. Like next year, is it going to be 2 years? Can't tell you that. But there are fundamental things happening like that debt you can't wash away or fake away. And that is the reason why you should have precious metals, because when that day comes, it's not going to be a pretty day. Strong dollar, American dollar, world reserve currency. Oh, wait a minute, what happened? You see how it happens in the other countries? They literally wake up one day and something massive just happened, and they're not sure what to do. The dollar's just been taken out, our $100 note's gone, $500 note, rupee's gone, 1,000 rupee gone, no real notice. Venezuela, we're doing the same thing, no real notice. But if any of those people in any of those countries had precious metals, they would have been affected like nothing. In other words, unaffected. I'm your host, JSnip4. Have a good day. Take care.